So welcome to the Rogue Trading Communities video, and this video is all about how to analyze charts the right way using volume spread analysis. So this could be one of the final videos for volume spread analysis series, but what I'm actually thinking about, I'm trying to upload the next phase of technical analysis concepts. That could be anything. That could be volume profile, market profile, order flow, or Elliott waves. After this particular video, I'm actually thinking about uh, taking the channel to the next phase. So that's the reason. It could be one of the final series. After this particular video, if there is any topics in VSA that if I have missed, then obviously I'll be uploading those particular concepts, or else I'll be uploading market analysis. So market analysis in the sense it could be post-market or pre-market analysis for Nifty, Bank Nifty, futures, it could be stocks for swing trading. So these are the things which we will be analyzing in the upcoming days using volume spread analysis. So those are the kind of videos that you might get in terms of VSA, but in terms of theoretical concept, this could be the final concept. Okay, could be actually, that's it. Okay, but apart from that, obviously I'll be hosting the courses for you guys, and obviously you will be learning it every single day because practical sessions are completely unlimited in the courses. Now let's get back to the sessions. Now, how to analyze charts the right way using VSA. So this particular video is very special because a lot of people out there who had this particular question that, sir, I have learned about VSA, I've learned about price action, we have learned all the signal of weakness, strength, buying climax, selling climax, and everything. But how to use all this particular knowledge and analyze the chart, view the chart the right way, and how to execute the trades. So that was one of the questions that most of the viewers had it. So that is the reason I wanted to make a video about it. Obviously student knows these things, but for subscribers this will be a really useful concept. Now let's get back to it. So now let's get started with the steps actually. So these are the 3 steps that I follow personally according to my own personal experience in terms of trading throughout these particular years. These are the 3 steps: the step 1, step 2, and step 3. So we'll be starting with the step 1, that is to understand the picture of the market respect to its time frame. So you have to understand the picture of the markets, then you have to step into understanding the price and volume and the market phases, and finally you will be understanding the probability and executing the trades based on the dominance of traders. Don't worry about it, I'll be explaining one by one. First, let's get on with the step 1. So what is the step 1? Understanding the picture of the market respect to its time frame. So that means, in simple, you are understanding the trend alignment from higher time frame to lower time frame and the market structure based on its overall picture. You are directly not analyzing the market, you're not executing the trades. First, you are viewing what's happening in the market. You have to understand that. That is something, the step 1, most importantly. Now let's get back to the charts and let's see how to do this actually. Okay, now. So right now we are in the Nifty futures chart of 15-minute time frame of trading view. Okay, so here as you can see, the market is on a lower lows right now. Market was in a higher highs for a very long time. Market was on an uptrend. Now market is creating a correction right here. So that could be one of the analysis for most of the traders right there. So even in terms of, let's assume if you are an Elliott wave trader, you would have thought that this could be was sort of a correction and market might create a higher highs from here. So that could be your assumptions, but let's analyze the markets in a bigger picture, right? So what is the step 1 is to analyze the markets respect to its time frame from higher time frames, right? So let's get back to the higher time frames a little bit. So this particular video will be trying to analyze for intraday point of view. Okay, so let's for intraday traders this could be really helpful. So just go ahead and just try with the 1 hour time frame or 2 hour time frame, it could be. So in this particular case, I'm just choosing the 1 hour time frame. I'm just zooming out and I'm checking the charts right here. So I'm checking the charts right here. As you can see, I see some sort of structure right here, right? So usually people don't do this. You know what actually do is you just draw the levels. You'll say that, oh, there's a resistance that's been forming right here and the market might reverse from these levels. That's not how things you should see. what I'd actually see right here is that I see a trend channel right here. See, perfect. 1 2 3 4, market is supporting the 50% levels every single time, right? Bounce back, boom. And right here, if I'm zooming out, proper structure, if I'm zooming in right here, as you can see, market broke this particular levels, and most of the traders would have thought, oh, this particular structure has broken, and you're gonna get a retracement and you're gonna get a breakout. In this particular case, what you can actually do is, if you have a confusion like that, make sure let the market break these levels. Until and unless market breaks these levels, do not assume for a buy trade. Do not go for a buy trade. Okay, don't take the trades on a retracement. If you would have taken a trade on a retracement, market would have gone on a lower low. So that is the reason. It could be anything. You could analyze stocks like this, you could analyze Nifty, Bank Nifty, anything like this, but I'm telling you the overall concept of how to analyze it. Okay, so one particular point where to take the trades on retracements, most of the price action traders, if you're one of them, don't take the trade on a retracement. Wait for the market for a breakout, let the market come down. If it is a proper test, obviously with a low volume test, it could be supply versus demand divergence, market will react it, market will create a higher highs, and based on that you might get a higher high momentum. But until and unless, wait for the market to break these levels, right? Once they break it, probably you might get a kind of a trend line retracement, and based on that you can take a trade right here. So wait for it, nothing to worry about it. Don't go for an early entry in terms of greedy. Don't do that. Wait for the confirmations, multiple confirmations, then you have to take a trade. Okay, in this particular case, the retracement got failed. Here supply got increased and market started creating a lower lows at this particular point of time. So we know that this was a pure resistance right here, right? So this was not a breakout. In fact, this was a resistance right here, right? That's the first thing. The second thing, understanding the price, volume and market phase. So this is where we will be using volume spread analysis. Okay, initially we were just looking at the higher time frame and the structure of the market, just a simple structure, just a price action, that's it, nothing else. Here we will be using volume spread analysis. So what we will be doing, let's get back to the chart right now, and as you can see right here, I'll be deleting it. And if I'm analyzing intraday time frames, so in terms of intraday, I'll be choosing only 3 time frames. That would be 5 minutes, 10 minutes and 15-minute time frame. Okay, so if you're a market profile user, then obviously you will be choosing 30-minute time frame. But even if you're choosing a 30-minute time frame, 5, 10 and 15 will be the default time frame for intraday. It could be anything. Okay, it could be market profile traders, it could be volume profile traders, VSA traders or order flow traders. It could be anything. In terms of intraday trading, 5, 10 and 15 would be applicable. And here in this particular case, let's go to the 15-minute time frame first. And as you can check the details, market from today, that is on 22nd August, market came down right here. It created a lower lows and market went down. And where was the opportunity? That is something that we'll be understanding in the step 3. But before that, let's understand it. The first bar of the day, you got a high volume activity, so obviously the smart money's presence out there, and you know that this particular phase where there was a resistance, market came down. And as you can check the details, I'll be drawing the important levels right now. Okay, simple, just high volume activities, nothing much. So if I'm zooming out right here, so as I can check, okay, perfect. So you have an area right here, this area. Until and unless this area will be broken, I'll not go for a buy trade. It's as simple as that as of now. Okay, until and unless this area is broken, I'll not go for a buy trade, but instead I'll only look for a sell trade right here. This area is your seller's area. Okay, this area is your seller's area. You have to understand that. Okay, that's one thing. Second thing, okay, most importantly, you have to understand the cause versus effect. You have to apply the Wyckoff's basic laws right here. So what are the 3 laws? The law of supply versus demand, the law of cause versus effect, and the law of effort versus result. Effort versus result, you might be using that on important levels. That is something that I'll be making in the next videos and so on. In this particular case, if you're analyzing it properly, if you're just zooming out properly, as you can see right here, market was on a higher highs for a very long time, right? Market was in a higher highs for a very long time. And what kind of phase is this? Is it an effect phase or a cause phase? Obviously it's effect phase, right? After effect, cause after effect. It's just like accumulation, again markup phase, reaccumulation, markup, then distribution, markdown, redistribution, markdown. This particular market phase keep continuing again and again. So in this particular case, what happened right here, market started creating a higher highs, and obviously market went towards the higher highs. So what you can actually do, if you're going on a lower time frame, as you can see, market did respect the nature. As you can see right here, market created a cause, you got an effect, again market created a cause, right? Then you got an effect, again market created a cause at this particular point, then market created an effect, and now after this day I'm expecting a cause again, right? I'm expecting a sideways market. After a cause you should get a, after the effect you should get a cause, after cause you should get an effect, after effect again you should get a cause. So this is the cycle of the market. Market gets exhausted, they observe the orders, and then they push the markets towards the higher highs or lower lows, right? So that is the law of cause versus effect in simple. Okay, so in this particular phase right here, as you can see, market had created a cause right here. This was a cause phase, and market broke these particular levels, and obviously the entire area, so this was a buy area, okay, right? This was a buy area, and market went up, and this levels has been broken. So usually in price action they say that if one particular support has been broken, that becomes your resistance, right? So the same thing right here, the buy area right here, right, the buy area right here broke towards the lower lows, and this became your sell area. Simple. Okay, so the buyer's area became a seller's area right here, most importantly. And what is the third cause, right? Third thing right here, understanding the probability and executing trades based on the dominance of traders. So in simple, if I'm just looking for an opportunity right here, you got a perfect opportunity right here. High volume activity, first thing. Second thing, you got a proper demand versus supply divergence right here. Proper no demand followed by a confirmation bar, exactly with a test on the high volume activity. Proper entry, stop loss, okay, short trade, entry, keeping a stop loss just above the no demand, and targets. Usually I keep minimum 1:2. Okay, usually I keep minimum 1:2. That could be my initial risk to reward ratio actually. But in terms of here, where I would keep the targets, if I'm zooming out a little bit, as you can see right here, there was a gap right here initially. Forget about this particular levels, and as you can see right here, there was a gap. Market was trying to fill this particular gap, it was unable to fill it, and obviously there is some levels right here, right? So if I'm drawing the levels properly, right here, again market came towards those levels, yes, and exactly market came up to these particular levels and it went back right here. So from here at this particular point here, market started its phase, and exactly as you can see right here, market took support, and it came back, and demand got exhausted right here. Again no demand followed by a confirmation bar. So this particular phase says that again there are no buyers in the market, and market pushed towards the lower lows. And what could be the ultimate levels right here for the next phase? So in the next phase, as you can see right here, if I'm zooming in right here, so this could be the right phase as of now. That's what I feel it. Yes, perfect, right? So this was the perfect levels. Okay, why did I draw this particular levels? Simple, this was the previous higher high, the leg got broken out, and market tried to push towards the lower low with an increasing volume, and market came back again and started respecting these levels. So this entire area now, this entire area is again buyer's area again. So again market came down and ended around the same area with an increasing volume right here, right? So this could have been your ultimate target. So you got a 1:2, that is your initial target. So if market again demand is being reduced right here and market is going on a lower lows right here, and what could be the ultimate target for a day? Because it's not like you're gonna get 1,000 points in a day. Obviously there is a limitations every single day. That is also something that you have to understand. In this particular case, there will be two types of targets. One is the minimum target and one is the ultimate target. So minimum target for you was a 1:2 and ultimate target was this particular levels. And maximum, what I feel is that if market is on a trending for a very long time in a day, it will be exhausted at some point of time, right? Obviously it will be exhausted. If market was completely trending for entire day, the next day could be the exhaustion for sure. So that is the entire cycle that I have observed in the markets from the past 3-4 years, and that is something that I have been through, and it has proved me right almost 95% of the time. So that is the reason. Proper no demand followed by confirmation bar gave me a confirmation saying that I can hold my trade, and market went towards the lower lows. So that was the third step, is to understanding the probability and executing the trades based on a dominance of traders. Is simple. Here the traders were dominating right here. So sellers were dominating, buyers got exhausted and sellers entered right here. This is the dominance. But if I'm taking an entry at this particular point, right? If I'm taking an entry at this particular points, and if I'm keeping my target minimum of 1:2 or maximum I got 1:4-5. Okay, let's think about it. But what if my stop loss got hit right here? That is also one of the points. So based on my risk management, I should also have one more counter step, right? If my stop loss get hit, I should have one more plan, right? So if I had a stop loss hit right here, so should I look for a counter trade? That depends upon the situation. What happens right here? In this particular case, market would have crossed the high volume activity level, right? If supply got exhausted at this particular point, then my target would have been the high volume activity right here. So I would have been looking for a counter trade also in this particular point based on the situation right here. So that means by looking for possibilities in the market, right? So that's what I meant right here, is that understanding the probability. If I had a stop loss hit, I'll be having a counter trade. If I having a target hit, fine. If I'm having a minimum target hit, it's absolutely fine. I'll exit the market. So I have my risk management intact, I have my trading psychology intact, and at the same time, I have all the possibilities. If this happens, I have a plan. If this particular scenario happens, then also I have a plan. So that is to understand the probabilities and understanding the market situations and executing the trades based on the dominance of traders. That comes the no demand and no supply divergence, right? So if you don't know what is no demand and no supply divergence, please don't be worried about it. I already made a video, I guess, in the YouTube channel. Go ahead and watch it. But usually the students know about it if you want to learn more about it. And usually what happens, people are not aware about it, but the volume spread analysis courses which I'm hosting here, the theoretical part will be for like 7 days or 8 days, but the practical sessions are unlimited. So students out there, they always have questions, and I host the sessions every single day, and I clear their doubts every single day for one-on-one sessions actually. So that is how I have kept it. There is no expiry for the volume spread analysis courses. So anytime when my students have the questions, they are messaging me, sir, I have a question, I need a 30 minutes or a 1 hour session, and I'm hosting that particular sessions. So that is how I'm approaching it, because I personally believe that a volume spread analysis is all about practical approach. It's not a theoretical approach. The more and more you practice, the more and more you'll understand about the market. That is how I'm approaching this. That is how I have approached it, and that is how I want my students to approach it, and all my viewers and subscribers also. So I hope you got at least an idea of how to analyze volume spread analysis properly. If you still have questions, don't worry about it. You can join the volume spread analysis courses. I'll be teaching you one-on-one. I'll be teaching you each and every part. Please don't be ashamed that if you're a beginner, you don't know nothing to worry about it. I'll teach you from the scratch and to the end. Even if it takes 1 month or 2 months to teach you, I will be there. I'll be hosting the sessions for you. I'll be teaching you every single day if it is required actually. So don't worry about it. I'm here to help you guys. So that was this particular video, and thank you so much. And we are literally reaching 1K subscribers actually. I'm really happy about it. I have no idea about it. I just uploaded, I started uploading videos just because one of my trading friends said that it is really good. You can just go ahead and upload it. But I started uploading it. I got really good, amazing responses from you guys. And I'm thinking about taking this channel to the next level. I'll be uploading more and more content, more logical content, which actually makes sense and which is easier to understand in the markets. So that is my vision for this particular channel, and for that I need your help, and that's just to share and subscribe and like this video as much as possible. So that's it for this video. Thank you so much. We'll see you in the next videos. Goodbye.